The current price for Plug Power Inc. NASDAQ plug is $2.65, showing an intraday gain of plus 5.58% as of the last close on November 7, 2025. Now, here is where we get straight to the interesting part, because the common expectation with a stock like Plug is that any upward move is simply speculative noise based on hydrogen headlines. But the reality right now is driven by a very specific material financial maneuver. The company is anticipating a liquidity boost of over $275 million, driven by the monetization of electricity rights in New York and other strategic operational efficiencies. This wasn't just a hopeful mention, it's tied to a signed letter of intent with a major U.S. data center developer, positioning Plug to provide auxiliary and backup power using its fuel cell technology in a high-growth, high-uptime sector. That shift from being solely a clean energy producer to being a critical power resilience provider for data centers is a far more concrete near-term catalyst than the market has traditionally priced in, and it's what's helping to stabilize the recent slide. The market's general perception of Plug Power is almost always a bifurcated view. Either they are the future of green hydrogen infrastructure, or they are a cash-burning machine consistently missing profitability estimates. The recent share price action, including the spike after news of this liquidity move, is a classic example of this push and pull. The stock had suffered a significant drop following an announcement of a warrant inducement agreement to raise $370 million, which caused immediate concern over shareholder dilution. This dilution risk, the reality of which hit the stock hard, momentarily overshadowed the more positive operational developments, such as a strategic partnership for a new renewable fuels plant and the successful delivery of hydrogen to a European project. This high-volume bounce-back, however, suggests that institutional players and short-term traders are now looking past the immediate financial pain point and refocusing on the company's efforts to shore up its balance sheet and tap into immediate profitable market opportunities outside of its core material handling business. If you look at the recent trading activity, the sheer volume tells a story. We've seen daily volume soaring well over 100 million shares, indicating heavy, concentrated activity, both selling pressure from the dilution and then aggressive buying on the strategic news. The stock is a favorite for retail self-investing platforms like Robinhood and for more sophisticated individual brokerage accounts at institutions like Fidelity, meaning news travels fast and generates rapid, volatile swings. The institutional ownership is significant, with major holders like Vanguard Group increasing their positions, which is interesting when you consider the persistent narrative of financial instability. These large asset managers aren't blind to the negative profitability, but their steady, large-scale holding increases suggest a long-term belief in the company's market position within the hydrogen space. The recent intraday gain isn't just a blip. It reflects a technical reversal from a recent low, amplified by the data center news. This creates a moment of tension. The expectation is more bad news around cash flow, but the reality is the company is actively and successfully executing on a plan to generate non-core asset liquidity to bridge the gap toward operational profitability. The deeper analysis of Plug Power has to focus on its position as an end-to-end green hydrogen ecosystem builder. This isn't just about selling a product, it's about controlling the entire supply chain, from production via electrolyzers to liquid hydrogen delivery to fuel cell systems for power generation. Historically, Plug Power made its name in the material handling sector, powering forklifts and other equipment for giants like Walmart and Amazon. That business provides a stable, if low-margin, foundation. However, the core investment thesis has always rested on the rapid expansion of its electrolyzer sales and its liquid hydrogen production network. Electrolyzers, which produce green hydrogen by splitting water using renewable electricity, are a massive growth vector, especially with strong policy tailwinds in Europe. The company has plants operational in Georgia, Tennessee, and Louisiana, and is steadily building out its 40 tons per day production capacity. Yet the reality of this grand strategy has been consistently painful. High capital expenditures, supply chain bottlenecks, and the massive cost of generating liquid hydrogen have led to consistent, deep negative gross margins and significant cash burn, which is why the stock trades well below its pandemic-era highs. The most anticipated event on the horizon and a key factor in the short-term tension is the Q3 earnings call scheduled for after market close. Analysts are collectively forecasting a quarterly loss of around minus 0.13 per share on revenues approximately $170 million. The expectation is a miss as the company has a bleak history of earnings surprises, having missed estimates in the last 4 quarters. But the reality that could potentially exceed expectations comes from 2 areas. First, the recent forward-looking strategic announcements, specifically the data center monetization and a major hydrogen supply agreement with the global industrial gas leader, which reduces the near-term pressure for self-developed generation. A strategic announcement about a concrete path to improved margins and liquidity, rather than just revenue growth, could be the unexpected insight that trumps a modest revenue or EPS miss. Second, there are strong whispers about surging electrolyzer demand and equipment recovery. Analysts predict that revenue from sales of equipment, related infrastructure, and other will approach $100 million. A significant beat on this equipment sales figure, signaling stronger demand for the core technology, would confirm the long-term thesis is still on track, despite the current financial headaches. Investors utilizing intelligent portfolio strategies or who practice online investing should be particularly attuned to management's commentary on the gross margin trajectory for the hydrogen fuel business, as that is the Achilles heel. Looking forward, the future outlook for Plug Power hinges entirely on its execution of the green hydrogen highway strategy and its ability to finally flip the switch on gross margin. The opportunities are clear. The global pivot toward decarbonization, the critical need for resilient zero-emission power in sectors like data centers, and the massive government-backed incentives in North America and Europe. The new strategic move into data center power is a brilliant tactical pivot. The data center industry needs continuous, reliable power, and Plug's fuel cells offer a zero-emission alternative for auxiliary and backup power, providing a potentially high-margin, sticky revenue stream that diversifies the business away from the material handling sector. This is an immediate catalyst that the market is just beginning to understand. The largest risk, the reality that could crush current expectations, remains the balance sheet. Despite the liquidity injection, the company still operates at a substantial loss and has a history of needing capital raises. The suspension of activities related to the Department of Energy loan program, while framed as reallocating capital, also introduces a question mark regarding government financing that many investors were banking on. For anyone who is engaged in self-investing, whether through the Fidelity mobile app or an independent individual brokerage account, the key to evaluating Plug is to stop fixating on the GAAP earnings per share for the next quarter and start asking, are the strategic moves leading to a verifiable structural improvement in unit economics? The European expansion, epitomized by the H2 Hollandia green hydrogen project, which links a 5-megawatt electrolyzer directly to a large solar array, shows they are serious about controlling the cost of green hydrogen production, which is crucial. If they can successfully execute these large-scale projects, the negative operating cash flow, which has been a major red flag, will eventually turn positive. The expectation versus reality dynamic is this. Expectation: Plug Power is a pure-play hydrogen speculative stock constantly under financial duress. Reality: the company is strategically monetizing non-core assets and pivoting toward the high-margin, immediate need data center market to self-fund its transition while simultaneously securing major deals and building out the infrastructure that validates the long-term thesis. The true value of the stock isn't $2.65, but what its future cash flows look like if it manages to succeed with just a fraction of its global green hydrogen vision. That outcome is still far from certain, but the new liquidity strategy significantly improves the company's chances of buying the time it needs to achieve profitability. Finally, a question for those of you following along who use platforms like Interactive Brokers Trading or perhaps one of the SoFi Invest tools. Comment below what specific gross margin percentage for the hydrogen fuel business Plug Power would need to hit consistently in 2026 for you to become a long-term buyer of the stock. To summarize, Plug Power is at a critical inflection point where operational progress is finally being matched by crucial tactical financial maneuvers. The market is slowly realizing that the company is taking aggressive steps to address its notorious liquidity issues, a reality that has fueled the recent price rebound and adds an unexpected layer of resilience ahead of what is likely to be a volatile earnings call.
The long-term vision of a comprehensive hydrogen ecosystem remains, but the immediate narrative has shifted to a story of financial engineering and strategic market diversification into high-value applications like data center power, a move that is much more grounded in immediate commercial opportunity than the market previously gave it credit for. The tension between the financial losses and the undeniable market-leading position in hydrogen infrastructure continues, but the company's proactive steps to secure funding and new market access give the bulls a stronger case than they've had in months. And what a key topic for a reminder, Pat, for our independent, monetized content for lucrative profits as we walk this long journey. Comment below whether you believe the recent $275 million liquidity move by Plug Power will be sufficient to cover its cash needs until its major hydrogen plants in New York and Georgia reach full-scale, cost-effective production in 2026.